What happens when the most critical industrial metal on the planet suddenly becomes trapped, not by geology, but by logistics? When the global financial system is forced to confront the reality that the paper claims it trades daily are backed by metal that may never physically arrive where it is needed. That question is no longer theoretical. It is unfolding in real time. As of today, silver is trading near $80 an ounce after briefly pushing above 82 earlier in the week. For most observers, this appears sudden. For those who understand silver's role in human history, it is anything but. Silver has served as money for more than 5,000 years, predating gold as a primary medium of exchange in several early civilizations. In Mesopotamia, around 3000 BC, silver functioned as unit of account, wage settlement, and store of value. The linguistic legacy remains visible today, as the same word still means both silver and money in numerous modern languages. Throughout history, silver occupied a unique position that no other precious metal ever matched. It functioned simultaneously as monetary wealth and industrial necessity. The Roman Empire circulated silver coinage across vast territory, enabling trade across 3 continents. When imperial authorities gradually diluted silver content to fund expansion, inflation hollowed out the economy from within. That cycle repeated across civilizations, each time reinforcing silver's tendency to reassert its real value during periods of monetary disorder. In the modern era, silver's industrial relevance has expanded dramatically. It is now essential to electronics, medical technology, solar energy, and aerospace systems. Every smartphone contains roughly 1/3 of a gram of silver, embedded in circuits where no substitute offers comparable conductivity. The average gasoline-powered vehicle contains between 1/2 ounce and 1 ounce of silver, while electric vehicles require closer to 1.6 ounces due to expanded electrical architecture and battery management systems. Solar technology depends heavily on silver. Each photovoltaic panel contains approximately 20 grams of the metal, and global solar deployment has grown at more than 20% annually for nearly a decade. Medical applications consume vast quantities as well. Silver's antimicrobial properties make it indispensable in wound care, surgical instruments, and implanted devices, together accounting for hundreds of millions of ounces every year. These industrial realities explain why silver behaves differently than gold during economic stress. Gold demand is overwhelmingly financial, driven by investment and jewelry. Silver demand is roughly split, with industrial consumption accounting for nearly half. That dual character creates price dynamics unlike any other asset. When monetary pressure and industrial demand rise together, volatility becomes extreme. This dynamic was briefly exposed during the silver squeeze of 2021, when retail investors collided with industrial buyers. Spot prices approached $30, while physical premiums soared beyond 50% in some regions. During that episode, London vault inventories fell by roughly 25 million ounces in just 2 weeks. It was a warning that the global silver market operates with far thinner physical margins than paper trading suggests. In New York, futures exchanges trade the equivalent of nearly 1 billion ounces of silver contracts on an average day, roughly matching annual global mine production. This enormous leverage between paper claims and physical metal creates systemic fragility. It remains hidden until delivery demands exceed available inventory. Between 2023 and 2024, silver traded calmly between $22 and $26, fostering complacency. Beneath that stability, however, industrial demand exceeded mine supply by nearly 100 million ounces annually. According to industry data, the market recorded its 4th consecutive year of structural deficit. Those gaps were filled by above-ground stockpiles accumulated over decades, a finite resource that analysts warned would eventually run dry. Financial conditions worsened after the regional banking stress of 2023. Elevated interest rates through 2024 strained commercial real estate and bond portfolios across the banking system. Investors once again sought hard assets as confidence in currency stability eroded, echoing patterns seen during the global financial crisis. China's economic slowdown temporarily softened industrial silver demand, masking the severity of the deficit. Yet Chinese refineries quietly accelerated stockpiling. By late 2024, inventories on the Shanghai Futures Exchange approached 7,000 metric tons. Western analysts initially misread this accumulation until export controls clarified Beijing's intent. Mexico remains the world's largest silver producer, supplying roughly 212 million ounces annually, about 1/4 of global output. Peru contributes approximately 140 million ounces, together accounting for nearly 40% of global mine supply. As 2026 began, a convergence of shocks emerged that few had anticipated. In late December, China announced that silver exports would require licensing, limited to a small group of state-approved firms. Effective January 1st, this decision placed effective control over the majority of refined silver supply into Beijing's hands. Western refineries dependent on Chinese feedstock suddenly faced operational uncertainty. The timing magnified the impact. Announced during the holiday period, many trading desks were understaffed. When markets reopened, participants confronted an entirely altered supply landscape almost overnight. The situation escalated further as geopolitical instability introduced an entirely new layer of disruption to global silver logistics. During the first weekend of 2026, events in Venezuela triggered immediate shockwaves through international shipping markets. United States military action targeting Venezuelan leadership resulted in the capture of President Nicolas Maduro and his wife, abruptly destabilizing maritime security throughout the Caribbean and adjacent Atlantic routes. Although Venezuela itself is not a major silver producer, the implications for global transport were immediate and severe. Insurance underwriters reacted by sharply raising risk premiums for vessels transiting the region, with some routes experiencing increases exceeding 300%. Shipping companies responded defensively, rerouting cargo where possible and anchoring ships in port elsewhere when security assessments became unclear. These decisions instantly slowed the movement of bulk commodities, including mineral concentrates critical to industrial supply chains. Peru's silver exports were quickly caught in this logistical web. The country relies heavily on both Pacific and Atlantic shipping corridors, and the port of Callao handles the majority of its mineral exports. Delays at this single hub cascade rapidly across global markets. Even short interruptions create downstream shortages as refineries operate on tightly scheduled delivery cycles. At the same time, Peru faced intensifying domestic disruptions. Illegal mining networks, which have expanded significantly over the past decade, began targeting transportation infrastructure. Road blockades in key producing regions prevented legally mined silver concentrate from reaching processing facilities. These blockades did not discriminate between lawful and unlawful operators, meaning even fully permitted mines experienced forced shutdowns as logistics collapsed. Combined with international shipping delays, Peru's effective silver exports were reduced by an estimated 40% within days. Under normal circumstances, a disruption of this scale from a country responsible for roughly 15% of global supply would dominate market headlines. This time, it coincided with other failures, amplifying its impact rather than standing alone. In Central Africa, Chad unexpectedly emerged as another pressure point. Although not a major silver producer, Chad functions as a transit corridor for mineral concentrates from landlocked nations moving toward coastal export terminals. Early January reports indicated rising regional instability threatening these transport routes. The resulting bottlenecks affected not only silver, but also copper and cobalt shipments, intensifying fears of broader industrial metal shortages. Mexico added further strain. Authorities announced temporary suspensions of non-essential activities affecting mining operations in several major producing states. While reasons varied by region, the combined effect reduced output from the single largest contributor to global silver supply. The timing could not have been worse. These overlapping disruptions in China, Peru, Chad, and Mexico produced what traders quickly labeled a double supply shock. Those tracking physical flows understood immediately that futures markets would soon face a reckoning. Registered silver inventories on the New York Futures Exchange have declined steadily since 2021. Current stock levels are low enough that sustained delivery requests could exhaust available metal within weeks under normal trading conditions. This vulnerability exists because the exchange was designed primarily for price discovery and hedging, not mass physical delivery. Most contracts are rolled forward rather than settled with metal, a system that functions smoothly until it suddenly does not. Evidence of strain appeared overseas first. In late December, physical silver transactions in Tokyo occurred at prices equivalent to roughly $130 per ounce. This divergence between physical pricing in Asia and paper pricing in New York signaled a breakdown in global arbitrage mechanisms. When industrial buyers are willing to pay almost any price to secure immediate supply, it reflects urgency that paper markets cannot easily absorb. As markets reopened after the weekend, domestic investors were confronted with the cumulative effect of these developments. Silver futures surged past $80, hovering near that level despite the sharp move. Even so, futures prices remain far below reported physical premiums overseas, implying additional upward pressure. Discussion of force majeure entered the market lexicon. Force majeure clauses allow suspension of contractual obligations when extraordinary circumstances prevent performance. If major refineries in Europe or North America declare force majeure due to inability to source concentrate, the cascading effects would be profound. Manufacturers of electronics, medical devices, and solar equipment would face immediate uncertainty and potential shutdowns. This episode highlights broader lessons about modern supply chains. Just in time, inventory systems have improved efficiency but eliminated buffers. Companies that once held months of raw material inventory now operate with weeks or days. That efficiency becomes vulnerability when disruptions occur simultaneously across multiple nodes. The silver crisis of early 2026 illustrates how rapidly this transformation can occur. It also underscores the difference between financial exposure and physical ownership. Exchange-traded products may track silver prices, but the nature of their holdings varies. Allocated metal with serial numbers differs fundamentally from claims on pooled inventory when delivery becomes constrained. Retail markets reveal the truth quickly. Dealers across North America report shortages of popular bullion products, such as American Silver Eagles and Canadian Maple Leafs. Available inventory carries premiums 40 to 60% above spot. These premiums reveal the true clearing price for physical metal in small quantities, far above futures quotations. For investors who accumulated silver during the calm trading range of prior years, this environment validates a long-term strategy. Those attempting to acquire metal now discover that price alone does not guarantee availability. Crisis periods often make desired assets both expensive and scarce, rewarding foresight rather than purchasing power. This disconnect between price and availability illustrates a core principle that many investors only learn during crises. Markets do not merely price assets, they ration them. When supply chains fracture, access becomes the scarce commodity. No amount of currency can instantly create refined metal that does not physically exist in the right place at the right time. Silver's current behavior makes that reality impossible to ignore. The broader economic consequences of sustained elevated silver prices extend far beyond bullion markets. Technology manufacturers face rising input costs, as silver represents a non-negotiable component in circuit boards, connectors, and precision electronics. These costs inevitably pass downstream, raising prices for consumer devices already facing demand sensitivity in a fragile global economy. Even modest increases in component costs can ripple through tightly optimized production models. Renewable energy faces similar pressure. Solar panel manufacturers rely heavily on silver paste for photovoltaic cells. Higher silver prices translate directly into increased panel costs, potentially slowing installation rates. This slowdown could interfere with renewable energy targets that governments have embedded into climate policy frameworks. A metal representing a tiny fraction of a finished product, ES mass, can exert outsized influence on deployment economics. Electric vehicle adoption may also feel secondary effects. EVs require significantly more silver than internal combustion vehicles due to expanded electrical systems. Rising material costs may compress margins or force higher sticker prices, potentially slowing adoption rates at a time when governments are mandating accelerated transitions away from fossil fuel transportation. These downstream impacts highlight how disruptions in a relatively small commodity market can propagate throughout the global economy. Silver's total market size is modest compared to energy or agriculture, yet its industrial indispensability gives it systemic importance. Monetary implications also emerge. When a physical commodity rises sharply in price relative to fiat currencies, it implicitly challenges claims of purchasing power stability. Central banks prefer inflation narratives focused on services or temporary bottlenecks, not tangible shortages in foundational industrial inputs. Sustained commodity inflation complicates policy decisions, particularly when economic growth elsewhere is slowing. The Federal Reserve and other central banks now face conflicting signals. On one hand, slowing growth argues for accommodation. On the other, rising commodity costs feed inflationary pressure. Silver's price behavior embodies that tension. It reflects both monetary uncertainty and physical scarcity, a combination that historically proves difficult to manage. Market participants now watch developments closely. If Chinese export licensing remains restrictive, Western refiners may face prolonged feedstock shortages. If maritime instability persists, shipping insurance costs could remain elevated, embedding higher logistics costs permanently. If disruptions in Peru or Mexico worsen, supply elasticity may prove far weaker than models assume. Under such conditions, a move toward $100 per ounce no longer appears extreme. It becomes a rational response to constrained availability. Conversely, rapid resolution of geopolitical tensions or policy reversals could trigger sharp corrections. That uncertainty itself carries educational value, reminding investors that commodity markets resist linear forecasting. Silver's role during this period reinforces its historical function as portfolio insurance. It performs best not when systems operate smoothly, but when assumptions fail. It is not merely a hedge against inflation, but against complexity, fragility, and over-financialization. The events unfolding now also expose the limits of paper markets. Futures contracts, derivatives, and exchange-traded products create liquidity and price discovery, but they cannot conjure metal. When physical delivery becomes paramount, abstractions give way to reality. Those holding contractual claims may find themselves competing with industrial users whose need is immediate and non-negotiable. This is why distinctions between allocated and unallocated holdings suddenly matter. Allocated metal represents ownership of specific bars. Unallocated claims represent exposure to a pool. In calm periods, the difference feels academic. In stressed conditions, it becomes decisive. Retail behavior reflects this awakening. Buyers are no longer comparing spot prices alone. They are asking about delivery timelines, mint capacity, and vault availability. Dealers field questions about back orders rather than discounts. This shift in behavior signals a deeper change in perception, from price speculation to supply security. For those who accumulated silver quietly during years of low volatility, the current environment validates patience. Buying during periods of disinterest requires psychological discipline. It feels uncomfortable precisely because it lacks reinforcement. That discomfort often marks opportunity. For those arriving late, frustration dominates. Even with rising prices, the inability to source metal generates anxiety. This emotional contrast illustrates another investment truth. Markets reward preparation, not reaction. Looking ahead, silver's trajectory will depend on resolution or escalation. Supply chains may adapt, new sources may emerge, and policy decisions may shift. But rebuilding buffers takes time. Mine development spans years, not months. Refining capacity cannot be expanded overnight. Logistics networks recover gradually, not instantly. The lesson extends beyond silver. Modern economies have optimized for efficiency at the expense of resilience. Redundancy was stripped away in pursuit of margins. When shocks arrive simultaneously, system strain, silver simply makes that strain visible. Future analysts will likely study this episode as a case where physical constraints reasserted dominance over financial abstraction. They will examine how quickly confidence in paper structures eroded once delivery became uncertain. They will note how a metal long considered mundane forced a reconsideration of risk.